And Laurent is very active in small to mid-sized LBOs. He was previously at REL Partenaires, and now he joined SPEF LBO, which is dedicated to small and mid-sized LBO, and has done some interesting deals recently. And Rémi Terrail, no need to introduce BC Partners. This is a large LBO specialist and a pan-European LBO. And Rémi is a former banker, so it's quite interesting. He knows how to structure deal. And he has joined BC Partner in 97, already 7 years. And I'm Olivier Bossan from ED Mezzanine.
Right. Good morning. I've been asked to speak about value creation in LBOs. As you can imagine, this is a very vast subject. And frankly, if I knew the answers, I probably wouldn't be here and probably not sharing the secret anyway. So I think the content of this presentation is basically going to be a certain number of lessons learned from our point of view, primarily based on our experience of large LBOs in Europe. And that will be basically a highlight and a snapshot of what we've experienced and the sort of lessons we've derived. It's by no means a sort of complete view of how to create value in LBOs. Very quick introduction to BC Partners. We are an independent partnership. We are one of the largest pan-European LBO funds, established in 1986, completely independent, owned by its partners. We've made a total of 57 transactions over the last 18 years for a total value in excess of 33 billion. We tend to concentrate on large transactions, around €1 billion in average size. And the recent transactions we've done in France are Polyconcept, a promotional gift product company we bought in 2000. Elise, the secondary LBO in which we were the previous owner and we reinvested as a minority shareholder in 2002. And more recently, a transaction which is about to close next week, Picard, which again is also a secondary LBO. LBOs are a bit like war. I mean, everything is in planning. It's very easy to get carried away in the excitement of doing the deal and also to lose sight of what comes after. One of the first things that you have to keep in mind when you do a deal is that the most important work comes after the closing. Doing the deal is fine, but the glory you get from doing the deal is short-lived, and that's not the result you're trying to achieve. The real work starts after the closing. So there are a number of things that are important. I mean, obviously, nobody does a deal without having thought about a few things beforehand. The first thing is clearly the business plan. I mean, the business plan is effectively, it's not only a plan, it's really a contract between you, the management, and all the parties involved in the transaction, the banks. Generally, it's a good sign to see whether the management accepts to be incentivized on this plan. These days, in the competitive market in which we operate, all business plans are aggressive. The question is, how aggressive should they be? And it's generally a good test to see whether management accepts to be incentivized properly on the basis of that plan. And, it's really the moral contract that's driving everybody. Management has an undertaking to deliver it. And, the financial investor must have spent the time in due diligence to understand the business plan to be a valid partner for the management during the life of the transaction. The second aspect, obviously, is the financing. I'm not going to speak at length about the financing, just to give you a few highlights as to how the financing can affect value creation during the life of an LBO. This is, again, not supposed to cover all the aspects of the financing. I mean, things are fairly obvious, but a financing should really be adapted to the plan that you're trying to do, well, you are trying to achieve. I mean, of course, you should have enough liquidity to fund your growth, either by way of CapEx line or acquisition lines. But you should also think about dilution. If you want to do capital increases later during the life of the LBO and you have a mezzanine that has anti-dilution protection, you shouldn't really be doing warranted mezzanine. If you think the business has good hopes of being re-leveraged very quickly, you shouldn't really do a high yield, because a high yield will prevent effectively a recap. And clearly, if you think there are prospects for a quick exit, you should really think about financing that can survive an IPO or survive the exit generally. So it's important to have in mind a plan and incorporate that plan in the way you structure the financing. It's a good thing to be maximizing the leverage at the time you close the transaction to be able to pay the maximum price, but it's also important to think about how the financing will affect the life of the company after closing. Obviously, the financing should be accepted and understood by management. You know, it shouldn't be inhibiting the growth initiatives they will have to undertake during the life of the transaction. It shouldn't be castrating for management. It's something they have to live with and get comfortable with. And the last thing is obviously during the life of an LBO, things not always happen in the way they were supposed to. And therefore you have to think about your downside and the fact that you will have potentially to go back to the banks and ask for waivers or permission to do certain things that were not in the original business plan. And these are not necessarily restructuring situations or situations when things are not going in the right direction, but things simply that were not in the plan, an acquisition that was, you know, slightly bigger than expected or things like that. And at that point, you really want, obviously, to have, it's obvious, a covenant package which is flexible enough to give you the headroom you need, but also to have a manageable banking pool. So, you know, you want to play and negotiate the majority bank rules as much as you can, get the thresholds as low as you can, and also try to monitor, keep an eye on the syndication process, and try to think about the size of your banking pool and the way you are going to obtain majority decisions when you need them in fairly short order. The last point I think that has to be thought about before the LBO starts is the relationship you establish with your management team and the way it's going to work. I mean, obviously, when you're looking at secondary LBOs, it's relatively simple, but when you're looking at either family companies or group divisions that are transitioning to a standalone status, it's relatively new for the management, and you should establish quickly the basis on which you are going to cooperate. So obviously, you know, the separation is relatively clear, especially in France, between the role of the shareholders and the role of the management. The management is in charge of the day-to-day business. They're spending 100% of their time with the company. And as shareholder, you're never going to know the company as well as they do. The power of the shareholder is a power of influence and initiative. The shareholders are here to introduce change, to contribute their wider business experience to the company, help its development, help by its contacts, you know, either in countries or sectors where the company wants to diversify. And the shareholders are there to keep the financial discipline, basically make sure the company keeps its controls right, remains profitable, cash generative, and if the time is right and the situation deserves it, organize a recapitalization to manage the balance sheet efficiently. Generally, the senior people within the investor team also act as a sounding board for the CEO. It's, you know, you should establish an informal dialogue with the CEO, try to get the communication channels right, make sure you have informal sessions with the management, and make sure that the management is you know, will give you advance warnings if things are changing or not going in the right direction, you know, sufficiently in advance that you can react. So it's key to be transparent. Obviously, it's key to adapt the reporting standards to what you need to monitor efficiently the company. And obviously, you know, it's always more difficult when you're dealing with a consortium because there are all sorts of role-playing situations that happen. It's always easier. Not that consortiums are necessarily bad in themselves, but it's always simpler when there is only one shareholder. One very important point is that LBOs are done under the pressure of time. Not that the LBO investors are necessarily taking only decisions in their short-term interests, but it's clear that when you are in an LBO situation, you need to act quickly. If you are there for a period of 3, 4, 5 years, you need to impose change right at the beginning. So our experience is that if you have to make management changes, you should make them quickly. Clarify the situation, put the people in the right place so that the change you want to introduce is introduced quickly. You need to develop very quickly the standalone functions, get rid of the administrative stuff, and concentrate on the value creation. And also, when you are dealing with a company which is new, and we were talking before of group divisions moving to a standalone status, these divisions have no identity of their own, so you should aim to create an identity very quickly, communicate internally to employees and externally to the various partners of the company, whether they are customers or suppliers, very quickly, and try to establish a sense of identity of that new company. It's very important also to have some good news early in the deal. It's go after the low-hanging fruits, things like decreasing the working capital, reducing costs quickly, showing good numbers at the beginning, creates a sense of momentum, and also shows that the business plan is real. It's not just an intellectual construct by the investors. and it gives everybody a sense of direction. Now, the typical value creation strategies, I mean, again, this is not supposed to be a list of how you create value in LBOs, but there are clearly, when you look at what the deals have been over the last 10 years, there are clearly a number of key strategies that are relatively easy to identify. On the first type is what I call organic growth, where you have a high-quality company already very well performing, cash generative, and basically you are buying this very high company and you're believing that this company can continue to grow. There is a very clear path to additional growth. So these are companies that have sort of utility type characteristics. So companies that like Elise, which is a transaction we did in 1997, strong barriers to entry. What you want to do there is preserve the business model, keep the management focused on that business model. If possible, accelerate the capex, because if you have a very good business, you want to push management to put more capital at work, provided it remains efficient in terms of return. You may want to look at diversifications, add-on products. And you also need to look at the management team and cope with the growth, reinforce the management team as needed during the life of the transaction. The second type, which is quite the opposite, is the restructuring plays. I mean, clearly, these are more difficult and more risky transactions. Clearly, there is generally a question of management, whether you have the right management to introduce radical change. Again, you need to act very quickly, even quicker than under normal circumstances. And restructuring plays generally are not very good exit stories, because once you've done the restructuring, there is not much to go after, or at least that will be the perception of a potential buyer when you want to exit. So you need to reinvest part of what you've saved in additional growth and try to move from restructuring to organic growth typically and try to develop a sustainable growth story. Consolidation is another strategy which has become increasingly popular over the last few years. I mean, clearly, very much on the large LBO, there is always an element of consolidation. Acquisition is very rare when you buy a company of a 1 billion euro value, that this company is not going to make acquisition in some form or shape. So, there is always a question there whether you make one big strategic acquisition, which is, again, intrinsically more risky than doing serial small acquisitions where you have no management issues, you just integrate the company very quickly in your existing operations. Clearly, you need to extract synergies quickly. You need to resolve the management issues, especially if you are merging two companies of comparable size. You will have to make tough choices about who's the management of the combined company. And clearly, the financing has to be looked at in the case of a major acquisition. And finally, just to be complete, breakup is the last strategy you can think about, which is identifying those assets in the company you're buying that have more value for third parties than for yourself. And there you're always facing the same issues as to whether you should sell quickly and focus on the core business or whether you should wait and maximize value. You need to think about the management issues. You need to incentivize the management in such a way that although the group is shrinking, the company you're buying is shrinking in size, they remain motivated, and also the managers who are managing the assets that you are selling are motivated to maximize value for you. I mean, generally, clearly in a large LBO, you never have a sort of single story. You have a combination of these stories to some extent. You have some element of restructuring, some element of acquisitions, and obviously, hopefully, some element of organic growth. Now, what has been our experience? I mean, this is based on a sample of about 21 transactions. This is a study we made a few years ago. Clearly, the key to value creation in LBOs is not contrary to the popular perception that it's purely deleverage. It's essentially EBIT growth. It's a combination of expanding the EBIT margin and also growing the EBIT in line with the sales, which contributes, in our experience at least, about half the value creation. And obviously, there is an effect of multiple expansion. We like to think that multiple expansion in some way is correlated with EBIT growth. So if we manage to achieve EBIT growth, there will be multiple expansion at the exit. This is not always the case, but. Now, I'm just going to go through very quickly through 2 or 3 case studies which are based on our experience of transaction of which we have either exited or are well advanced in their lives, just to give an example of the sort of things we've done and managed to create value on successful transaction. The first one is a very clear case of a combination of organic growth and consolidation. Elise is a well-known company. It's an LBO that was done in 1997, which we exited in 2002. It's a company we acquired from its family shareholders. It had very strong fundamentals, good prospects for organic growth, low penetration of the sort of services the company was providing, so no problems for finding new customers. It's just a question of managing them and managing the growth of the company. A lot of add-on acquisitions, potentially, both in the US and in Europe. The company had a very substantial operation in the US, and a very strong management team, obviously. So the story was that we developed very successfully the US. Sales increased by about 50%, EBITDA even more. There was a combination of organic growth, but we did 12 acquisitions. So these were consolidation strategies. So basically buying small companies, integrating them very quickly, getting rid of all the fixed costs, just keeping the sales and the gross margin. In Europe, same type of story, slower growth because the market is more mature. Sales plus 96%, EBITDA plus 42%. Clearly an effect of dilution on margin because some of the companies bought in Europe had lower margin than Elis initially. 7 acquisitions and introduction of new products. Elis was a linen rental company, and we've added a number of new services, and we've pushed them also to increase the cross-selling effort. So boosting organic growth based on very strong existing fundamentals. The company was recapitalized very successfully in 2000. We got the repayment of our whole initial investment, and then it was sold in 2 separate transactions in 2002. The US was sold to a strategic buyer and was consolidated into a larger player, and the European operations were sold in a secondary LBO in which we reinvested as a minority shareholders because, again, we were very convinced that because the company has such good organic growth prospects, the story doesn't end with the first LBO. The second story is quite different. It's Aviagen, which is a group which is the result of the merger of 2 large poultry breeding companies which we bought in 1998 and 1999. So the 2 companies were not of the same size, but of relatively similar size, and this was really a case of building a world leader by merging the existing number 1 of the industry and the number 3 company. Ross Breeders was primarily a European company, and Arbor Acres, which was the second acquisition, was essentially based in the US and in Asia. So there was a lot of synergies. Pro forma EBITDA in 1999, 21 million, which was about an EBIT margin of about 15%. The industry was growing organically very quickly because it's, people eat more chicken. It's like that. So there was intrinsic organic growth in the company, but there was also the perspective of creating a world leader with a lot of synergies by merging the 2 companies. So the merger went ahead very quickly. The second transaction was completed within the first year of the LBO. So obviously in these circumstances, as I said, you have to make some choices. So decided to close the head office of the largest company, appoint the management of the smallest company, relocate the head office to the US, and combine R&D, combine sales force, and organize the cross-selling of the products between the 2 companies, selling the products of the European company to US customers and vice versa, and try to extract as much value as you can and do it quickly. The result was quite successful. The EBIT margin went from 15% at closing to 19% within 4 years. There was a leverage recapitalization in 2002 because the company has substantially reduced its debt, and the company was sold in a secondary LBO in 2003. I mean, clearly that's one of the tricks in which you fall one of the traps in which you can fall when you implement this type of strategy is that suddenly the leader you've created is just too big for the industry and there's nobody to buy it. So it's either a secondary LBO or an IPO, and if the IPO market is not there, then it's a secondary LBO. Finally, the last example is one of restructuring, which is it's Galbani, a well-known mozzarella producer, formerly owned by Danone. Clearly non-core company for Danone, clearly undermanaged in the past. Very strong brand, slow organic growth, but some growth, and a lot of potential for cost savings. So the investment case was relatively radical, which was to change the whole management team, appoint a complete outsider, and completely shake up the company. So this happened very quickly. We've gained, on the transaction of about 1 billion, I think working capital was reduced by between 150 and 200 million euros, which is substantial. Costs were drastically reduced. And a lot of the savings have been reinvested in introducing new products, increasing advertising spend to basically create the growth story that will give us an exit. So, it runs contrary to some of the perception that, LBO investors are short-termist. Basically, we're trying to build from an undermanaged company, cut costs and reinvest these costs to give the company growth prospects that will give us an exit and put the company on a sustainable growth path. The leverage was reduced from 5.6 to 3.6 in a matter of about 2.5 years. So we have already organized last summer a recap through which we have already recovered twice our money, and the exit will come in a few years. But the company is clearly performing very well. Now the conclusions are relatively simple. Again, they are based on an experience which is worth what it's worth, which is it's always partial, it's always tainted by specific example. But it's very important to have a clear game plan in mind. The deal is not an end in itself. It's very important to have management on your side. You're not, you're only, the financial investor identifies value, but at the end of the day, it's management who is in charge of delivering the value. So they should be incentivized, and you should establish a good relationship with them. If you don't have the right people, you should try to change them. It's very important to act quickly and get some good news at the start. LBO investors are there only for a limited period of time. They are not necessarily only interested in short-term gains, but clearly, if you want to exit in 3 years' time, you may just as well get started now. Run strategic initiatives in parallel. It's very rare that in a large transaction there is only one growth story. There are several running in parallel: acquisitions and organic growth, acquisitions and cost cutting, and these should be run in parallel. And it may be slightly schizophrenic for the management team, but it should happen in this way. Manage the balance sheet very quickly, very aggressively. If the company is under-levered, you should manage the return on capital by re-leveraging the company, which is good for everybody. Clearly, if you have a clear value creation story, you have more exit options. It facilitates your liquidity at the end. You can have a credible IPO, and it could also be attractive to an industrial buyer or to a secondary LBO. And at the end of the day, it's hard work, no pain, no gain.
Good morning, gentlemen. As you can imagine, it's quite challenging to speak after Remy from BC Partner, which BC Partner is typically one of the eldest and probably famous private equity house in our industry. And what we discussed together is probably to give you a focus on what we do here at SPEF LBO inside Natixis Private Equity, which is a focus on small to mid-sized buyout. I think, of course, we are sharing a lot of the statements that have been described to you, but on top of that, I have to add that we, as a small to mid-sized player, have to rank the criteria of investment selection and strategy. So what I propose is a presentation of what is key for us, and as a clear statement is for a lot of players in our segment is when we have to rank the criteria for investment, we put management first, management second, management third. This is probably something highly typical of our small deals, as a lot of the value creation is clearly on the shoulders of the management team. So we'll try to describe you the way we assess the management before the acquisition, during the acquisition, of course, and the way we monitor that. Then a brief description of the type of strategy that we try to concentrate on, which are more or less the same, but probably with a different ranking and potential as far as small size is concerned. Okay. Thank you very much, Olivier. As a start, I will not skip some propaganda and presentation of SPEF LBO. Of course, so SPEF LBO is, as everyone knows, one of the leading French private equity firms on the small to mid-sized buyout segment. We have accomplished over 50 transactions in this segment, and we focus clearly on reorganizing the ownership of mainly private equity held company and helping them to grow. We currently manage 85 million euro, and clearly we focus on high value added businesses, typically with sales up to 100 million euro. We clearly close work closely with the management, and this means a very short relationship, as the management team is generally a couple of key people in the organization, and we help them to grow and make suitable acquisition when it's interesting to do so. We are also organized as a very small company inside the larger corporation of Natixis Private Equity, but the team is highly decisive, which make the decision process as short as possible and make it easier for management to cope with critical issues. So a difficult topic is effectively to assess management ability to ride change and growth, which is something that is for us a key criteria for doing so. We try to rank them and try to review those criteria all along the process. Typically, we generally have to focus with niches, which is difficult because you have to have feedback from experts in the industry, try to get information about what are the challenges the company will have to face in the industry. And the first thing we try to discuss with the management team is effectively the vision they have of this challenge and the way they want to handle this in the future. Then I think that the key criteria for us, as most of the case, growth is part of the project, is the flexibility of the organization and the quality of the people of the key position. Then I think two other criteria are clearly something that makes a difference between the projects that we decide to back and the others is innovation. Innovative approach to add value to the business is key to grow, and the entrepreneurship culture of the companies is also something which is decisive for us. Then there's the last point is something that most of the small companies lack, which is the quality of management information system. And so we also are backer of improvement on this topic and have a long experience of putting in place those type of management information system, even on very small company. Pre-acquisition due diligence, of course, we try to understand the current organization, the decision process, and the corporate culture. We try, with discussion and interview, try to identify the potential and the limit of each of the manager, which that's always as easy as you can imagine, because we're very often in time pressure, but we try to create the type of relationship that give you this possibility to share the views and try to understand the personalities of each of the managers. Then there is a review of the business plan, and of course, we review the business plan and the products, the market topic, but we really want to stress with the management what this plan will imply in terms of change of people and improving, recruiting new resources from the outside. And this we want to make clear with the management that this will imply probably change in most of the case. Then we try to review, of course, the past is very often a good indicator of the capacity of the management to cope with issues, and we try to review the type of issue the companies have already faced, and then try to imagine what could happen in the future. We do that, of course, by your own. This is something that you cannot delegate because it's a key decision for us. But of course, as time is short and capacity is limited, we very often have a human resources consultant on our side to help us to do the checks and the reviews. Then, as Remy said, then the games begin and the work starting. So then what we do, and this is part of our own internal portfolio assessment that we do twice a year, full reassessment, and management assessment is completely part of our process, which means that we review what have been described in the plan. If the reinforcement of management team has been agreed, we stick to the fact that this is implemented, and we try to help as far as we can the management to, first of all, to identify the appropriate profile, but also to attract them, because the fact that investors along in the equity of a small company is clearly a fact of attractivity for external managers to join the club and the capacity of share the gains. We regularly review, of course, the team ability in order to anticipate together the future needs, and we stick to that every year so that there is no surprise in doing so. And of course, we have to share with the management the adaptation of the incentive scheme in order to have everyone interest aligned with the investors. What we try to do, and this is probably more difficult on small deals than other, is to also establish various lines of communication between the management teams and our team, just to not only get the voice of the CEO, but also get the feedback from the different people in the organization. And as the organization is small, you can imagine that it is highly sensitive, and this needs a lot of psychology in order not to have the CEO in a challenging position of authority to the other members of the team, and we don't want him to be outside his responsibilities. Of course, when we see the different strategy, add-ons acquisition is frequently part of the program, and the adaptation of the management team is something that we also carefully review, and which is probably more important is the cultural impact of a merger, of any acquisition, specifically when two companies are competing together for years. There might be a lot of troubles having those people working together for the future. Then if we move to the different strategy for creating value in small to mid-sized buyout, I think organic growth typically comes first, because it's the most frequent opportunity a small company have in front of him. First of all, to increase market share, to develop complementary product or service, and improve its productivity. And this usually is a very, very nice game for an investor. The risk-reward rating is pretty good. Then international development is, of course, part of the potential. We know that it's a long-term bet, and we've tried to focus and do it through acquisition, which make it easier and faster. As we'll discuss later on today, we are on the time frame that is quite short, and acquisition is probably the best option for doing so in most of the case. Then the work of structuring the companies is also very important to face the growth potential, and we try to do it as early as possible in the growing process. And if we can just give a case study about this type of growth we could face, there's here a very simple and very illustrative case study of a company that we recently bought, which is very small companies, probably the smallest one we ever done, but probably the most interesting one, as CEFI is a leader on online performance marketing affiliation in France, which is an internet service provider, which is something quite unusual for a buyout specialist, but time have changed, and a couple of very profitable companies coming now from this market segment, and CEFI is typically one of these fantastic companies that have been set up in July 2000, just after the big crash of the internet, and the business model based on performance fee share between SimpleClick, his affiliate partner, to have advertiser expose their advertising on the net is a very profitable model. The companies have always been profitable and now enjoying a very strong growth. We probably have never had that in our portfolio before. The companies double its sales every year, which is something that you have to cope with a lot of issues, as you can imagine. And this demands a lot of work from the team in terms of backing the management, help them to grow internationally. And the growth, as you can imagine, now is sustained by increasing online sales and a larger portion of marketing budget to the internet. So this is typically a small company, but you can imagine that if the sales doubles with a 20 plus percent EBITDA margin, the value creation for this deal is very strong for us, but very challenging because we know that we are in a segment where things change very quickly. Then second strategy, which is very frequent on small to mid-sized transaction, our build-up strategy. And here there is clearly two types of game. The game of acquiring small companies based on a first acquisition that we call a platform company is very interesting as additional risk is quite limited. Acquisition of a larger company is always more challenging. This required a full reassessment of the project. This needs a lot of work from the VC, making sure that the financing will be in accordance with the requirement of the new project. But as you can imagine, this also could be a fantastic leverage in terms of, and we know that today, multiple expansion is something that is more and more doubtful because the competitive in all the segments of the buyout market is very high. Nevertheless, as small to mid is concerned, there is clearly still a game in changing one category to another. And when we bought a company with, let's say, 30 million euro in sales and we bring into 60, we clearly integrate the mid-sized market where we are interested different type of trade buyers and financial buyer, and this is still a very good trick in terms of multiple expansion. Okay, just a summary of the different strategies. This is an example of build-up in a very unfashioned business, which is the supply of plumbing accessories for professional and specialized distribution in France. These companies have a very young and professional management team that have set up a first company with the merger of the two oldest players in this field, and really now got the support of his larger clients, who are the Castorama and the large distributors in France, who are highly interested in having a group that is able to improve the quality of the service they know they require from their suppliers, and we benefit from the support of the client just to make those nice, suitable acquisition for this group. Rapidly, the two other type of strategy we could encounter, which are probably less frequent. The first one is a repositioning, restructuring. We call it repositioning because it's very often imply a very important strategic move, which is a major change in distribution channel, in marketing, and this required a lot of preparation because, of course, this could bring a lot of potential and value creation if the execution is nicely done, but this is also of very high risk for the VC. We are facing this situation right now on a small company, which is a leading manufacturer of inkjet compatible cartridge, which is very clever recycling cartridge that are sold on the market by the brands and refurbish them and report them in the network. This company created in 1990 has a very strong growth up to now, sustained by the demand from the B2B distribution channel. And now that the quality of the compatible cartridge is established, there is a huge opportunity to expand the company in the mass market. And as you can imagine, the orders are very big. We got the opportunity next year probably to double the size of this 15 million euro sales company. So it's a small company, but with two new clients and the capacity to serve the mass market, there is a tremendous opportunity there. As you can imagine, this is very attractive for venture capitalists, but this is also a lot of preparation required in financing, in industrial, and what we have done first is just to hire new managers coming from this industry who have a long experience in mass market, and then moving to the next stage, which is preparing the company, the industrial part of the company, to face this challenge. Last one, less frequent, but it's still the case as family-owned company very often have accumulated companies and businesses that are not always have synergies between themselves, break up, and maybe Olivier remember that we have accomplished together such a deal in the press magazine business a couple of years ago. Then it could also bring a lot of value when we lead this properly. This is a very difficult exercise, as you really have to find the appropriate buyer for each of the parts that you want to sell, and try to maximize the value on each of the parts. You really have to find the suitable candidates and have the right timing and the right communication to do so. We are underway of a breakout right now of one of our portfolio company, which is Utinor, which is a group which is well known by the biota industry at this company. I've experienced 3 LBOs. First one was a success. Second have been tough years for bankers and investors. And the third is LBO that we lead with Ciparex 2 years ago is an interesting one, as we decide after years that probably the 2 entities of this group, one's focusing in France, the other one is developing on a large international project, are first of all standalone entities, and then really attract different type of buyers. And we have been solicited from different parties, and this brings us to the conclusion that at the end of the day, those 2 parts will probably end up with different shareholders. And we have implemented that this year with the sale of half of the group, and the rest of the group is now the core focus of the management team, and will probably will also have a very interesting exit in the coming years. At the conclusion, I will say that for value creation, exit multiple on small to mid-sized buyout is still a reasonable expectation, and this, of course, leaves a higher R, and this is good for all the investors. Debt prediction will continue to optimize the return. It's more mechanical, but nevertheless, today the name of the game is EBIT growth, which really gives a leverage to deliver superior returns. And as far as experience is concerned, the management teams clearly makes a difference, and we are always in search of talents. With talented people in the driving seat, we effectively think that success is at the corner. Thank you.
I have one question. It seems that management is one of the key points, and I wonder if it is, if you, in the larger deal, are focused to value creation, do you use often the old management, or do you systematically hire a new one? And does it happen that you have changed management during the time you have your participation to cope with this problem of value creation?
Well, I mean, as I think, as I showed in the examples I described, I mean, it very much varies from situation to situation. Management is always incentivized. Generally, when you look at large LBOs, there is already a fairly substantial management infrastructure. So you already generally, when you're buying large divisions from groups or even large family companies, they generally have a strong management team in place. They have strong information systems. And philosophically, we at BC Partners are more buyout people than buy-in people. But it happens that, like in the Galbani example, which I gave, we change management when we think that, the company has been so undermanaged in the past that basically you need to change things radically. And generally, the people in place, when you want to introduce radical change, in this situation, it's always better to change a number of the key managers, if not substantially all the management team. But it's very much a deal-specific decision. And sometimes when you're buying a group division, the incumbent management doesn't want to stay, so you have to find outsiders. clearly, one of the functions that changes and is under strain in an LBO is the CFO function. Again, taking the example of group divisions, very often when you buy a medium-sized group division, you have a controller. You do not have a true CFO in the company. So generally, that function has to be reinforced, but not always. You know, in a good number of cases, you find people with adequate potential, and you always reward management. You know, there is not a single deal we've done where management have not invested in the transaction. Again, our interests have to be aligned. And they should invest some of their own money, be investors, not just stock option holders. So they need to run the risk of losing some of their money, not too much because you know you don't want them to worry too much, but enough that you know it should keep them focused on the on the plan that we've decided together.
And for smaller deals, I think it's more difficult because the manager is sometimes shareholder.
Yes, this is an issue that we face probably in one case out of two. And as colleagues in the venture capital, we know that with growing small companies, you need to have an improvement of the management team, and these have to be being quite clear with the manager. And today, and I think there is a major change that is coming in this segment of the market, either the story of the old family-owned companies with old management is more and more over, and now we really team up with very outstanding managers coming from larger groups that have experience and also have the spirit of partnership, and they clearly understand and know and share with us that as far as the company is going, then there is key function that will need to be improved, and the reinforcement of management imply exactly what I was mentioning, that they imply a sharing of the profit, then the adaptation of the scheme, and we try to attract people with outstanding credential to reinforce the team with this spirit, and this have to be created at the beginning of the deal with a new corporate culture oriented toward growth.
In your presentation, we have seen that value creation relies mainly on organic growth or external growth, and there was no allusion to cost reduction. Or isn't it the best way to try to create value, to look at how this company is managed and try to first of all try to release the fat?
Well, I mean, I think cost reduction contribute to EBIT growth. So when you see EBIT growth, you know, it can come from cost reductions. I mean, yes, it's clearly one of the value creation drivers. I think, as I said, I think in the presentation is investment stories that are only based on cost cutting are dangerous because they don't give you a sustainable story. So, you know, if you are simply reducing cost in a zero growth business, then you won't have an exit because anybody who buys from you will have the perception that you've taken the value out of the business. You have captured the value that was to be captured, and there's nothing left for them. So it's very important in cost cutting to do not only cost cutting, but reinvest the savings and trying to generate a story for growth. And certainly in the deals we've done, when we did cost cutting to a very substantial extent, we've always thought to reinvest part of the proceeds. Obviously, you know, you reduce cost to reduce leverage and, you know, show improved EBIT, but you should also reinvest some of that to generate growth, otherwise you don't have an exit. And at the end of the day, you want to exit in good conditions.
And the small business?
I think in small business, cost reduction is probably more difficult in the sense that as the buyout is concerned, we are focusing on quite value-added businesses who are generating substantial operating margin, and therefore the capacity to reduce costs is often limited because there is more cost reallocation in a sense that we really want to have the management continue to invest in, as I was mentioning, management information system, which can be costly. We need new recruitments, and we prefer those companies to continue to maintain the same level of cost, even if there is no EBITDA immediate creation, but to be sure that the bases are here to sustain the potential. And we know that when we are looking for an exit, the size matters more than than the EBIT, specifically when you are targeting at the international trade buyers. The fact that you have reached a certain level of size is critical, as well as to attract the large mid-cap financial buyers.
Yes, please.
Could both speakers talk a little bit about their hit rate in terms of the number of transactions they execute on vis-a-vis those under which they undertake serious due diligence? And a follow-up to that point is what is the principal reason, having started serious due diligence on a deal, that you don't execute? Is it because someone's prepared to pay more money for the company you're looking at, or are there other reasons?
I mean, if I understand the question correctly, I mean, it's around due diligence. I mean, we always undertake serious due diligence on any deal we're doing. There is no way you do a transaction in excess of €1 billion and raise the debt and the amount of capital that's required without appropriate due diligence. And again, the due diligence has two objectives. One is enable you to assess that there is no risk, or at least no risk of such magnitude that it basically jeopardizes the deal. Secondly, form a judgment on what is the appropriate business plan, what you want to do with the company, and be an intelligent partner for the management team later on, because you understand the business. If you don't understand the business and things go wrong or not quite as expected, the only choice you have if you don't understand the business is change the management team. Clearly, there should be other solutions. So due diligence is a critical effort, and it's obvious to say. Then about the hit rate, about how many deals do we look at and start due diligence and how many we stop, it's very difficult to say. We're clearly looking at more situations than we actually do. It's a function of the sort of deals we like, the sort of risk you're prepared to take, and then, as you said, I think a function of the price people are prepared to pay. At the end of the day, I think it's a balance between risk and price, and that's, there is always a level at which you feel comfortable and others where you don't feel you're comfortable. So it's a competitive market. So certainly due diligence is not the only factor that explains that you have a low or a high hit rate between the sort of situation you look at and the number of situations you actually do.
If I may add, effectively, due diligence cost is today a major issue for every player in this industry, and as far as our segment is concerned, it's probably even worse, because we try to focus on deals, and there is a serious number of deals that are not on the market, because on small companies it's difficult to handle an auction process, as everyone knows, and there's a lot of opportunity to have discussion on the side of the clear sales strategy. But the fact is that a lot of mid-sized companies do not have the appropriate information system, are not prepared for transaction, which could lead us to misunderstanding in the numbers, misunderstanding in the marketing, and a lot of deals collapse just because the capacity to look through the company is not as good as when things are being well prepared. So it's always a challenge for us to choose. The opportunities are a little bit out of the market, interesting because not prepared for sale, because there are a lot of things that we could do, and we'll prepare that for the next 5 years, and the opportunity that are probably much more attractive, much more well presented, but which the price will be much higher. And as far as due diligence is concerned, you can imagine that the allocation is quite difficult, with one part where you have much more chance to find a very nice price and a very nice company, but you also could face something that you will make the deal impossible, and then the other part, very interesting opportunities, but with 30 competitors around the table. So this is a type of choice that we're making every day.
Maybe one question more. How do you cope with the problem of time? Because value creation takes time, and I think more time for large companies than small. And how do you try to integrate this problem of time in the creation of value?
Well, as I said, I think you have to start quickly. Again, I think it's not that the financial investors, the LBO investors, are only interested in short-term gains. I think when you look at an LBO, you're really looking at a period of 3 to 5 years for the LBO, plus you really have to have a convincing story for the next 3 or 5. So you're really looking at a period of 6 to 10 years. So you have to look at that as your ultimate value creation horizon. But you need to act quickly because 3 years is very quickly spent. And if you don't start immediately, then you get lost in all sorts of side directions which are not the right ones. And also it's very important to keep people motivated, and speed and pressure keep people motivated, and it's very important as well. So and we are looking for high returns. So it's obvious to say, and returns. Time is the enemy of returns. So. But whether it's more difficult in a large company or a small company, is debatable. I mean, clearly it's. You will comment on that, but scale clearly is a problem when you want to introduce change, and it's probably easier on a small company than on a large company. On the other hand, a large company has more infrastructure in terms of management and systems, which also makes change more easy to introduce. So there is a balance.
But you have, sorry, Laurent, do you have some discussion with your investors? And you are speaking, in fact, of creating value for the portfolio. But when you try to speak with investors, creating value for them, the time is something interesting. Maybe they don't want to stay 10 years and to see the company growing. Okay, that's very nice. But
no, well, I mean, there is always a balance between the multiple of the investment you make and the absolute return, and obviously all the investors want to have a balance between the two. There isn't, it's not very useful to have 200% return for 6 months. It's what is useful is to have a good rate of return, but over a sufficient period of time that you achieve an absolute gain which is substantial. So then it's a function of the transaction itself, of how your fund is performing. Some funds come under pressure to have quick exits at some point in time, and it's a function of how many new products you can generate for the company, and it's a function of management motivation. So it's extremely deal specific. It's very difficult to find a general rule for these arbitrage between the multiple of investment and the IRR.
Thank you, gentlemen.
Thank you.